At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly, truly, truly dramatic. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it.
The U.S. inflation rate has hit 2.0% as of July 2025, finally aligning with the Federal Reserve's long-term target for price stability. This follows a stretch of aggressive monetary tightening that began in 2022, aimed at cooling down stubborn inflation. According to the Truflation US Inflation Index, this marks a notable shift in the macro environment. But not everyone is convinced things are as stable as they seem. RickRule of Rule Investment Media isn't buying it. He argues that the official CPI numbers don't tell the whole story because they exclude taxes and other real-world costs that people face. In his view, the so-called positive real yield is an illusion. People aren't gaining, they're bleeding value slowly as the actual cost of living continues to rise outside the scope of sanitized government data. Since December 2024, the Fed has kept interest rates in the 4.25% to 4.50% range. That's a pause from the series of hikes that defined the earlier part of the decade. Chair Jerome Powell has successfully guided the transition into this new phase, but analysts remain wary. Underlying risks, like geopolitical shocks, supply chain disruptions, or domestic fiscal pressures, could easily reignite inflation or throw policy off course. Meanwhile, gold has been telling a different story. It's held above $3,400 for the second straight day, setting a new milestone. Silver isn't lagging either. It just hit a 14-year high in London trade. Part of that momentum is being driven by massive inflows into bullion-backed ETFs. But there's also a deeper current, growing fears over the Federal Reserve's independence as political tensions intensify. That's precisely why RickRule is doubling down on gold and silver. He sees through the headlines and into the structural cracks. As more people recognize how fast the dollar is eroding and how misleading the official data can be, capital will flow into hard assets. Gold will likely climb, but silver, with its smaller market and higher volatility, could surge even faster. And if past cycles are any guide, silver stocks won't just rise, they'll explode. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I've participated in 3 precious metals bull markets in my life. This will be the 4th. And at some point in time, and I'm never smart enough to say why, you probably are actually, given your competence in technical analysis as an example. At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly, truly, truly dramatic. And although I don't need to make more money, I want to make more money. I really, truly enjoy the game. I'm 72 years old, and I want to experience that sort of quantum escalation at least one more time in my career, and silver gives it to me. When I came into business, I'm older than you, as you know. When I came into business in the 1970s, I witnessed an amazing silver market. The stuff went from $1.30 in 1970 to $50 in 1981. One stock that I was aware of, but I was too dumb and too poor to buy it, was Coeur d'Alene. It went from 10 cents, this is not a typo, 10 cents in 1970 to $65 in 1981. And that stuck, you know, that stuck in a young man's mind. But I didn't participate. But as I think you know, in the later part of the 80s, the early part of the 90s, which was a spectacular silver market that people forget, I was involved in Silver Standard, which we took from 72-cent financing with a full warrant, thank you, to 6 years later, $45. And Pan American Silver from 50 cents, Ross Beatty was too cheap to give me a warrant, to $45. Those two moves, from below $1 to $45 in 6 years, stuck with me and have stuck with me forever. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it. I believe that the analog to the deterioration of the purchasing power of the U.S. dollar that we're going to experience is the 1970s. In the 1970s, according to the Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power. This is not some old fat libertarian, RickRule, saying this. This is the office, the Congressional Budget Office. I believe that because of the accumulated debt and deficit, particularly off-balance sheet debt, entitlements, and the unfunded entitlement liabilities, that the purchasing power of the U.S. dollar over the next 10 years is going to decline by 75% again. I don't know how it'll be reflected in the gold price, but the easiest thing for me to say arithmetically is that the increase in the gold price will mirror the deterioration of the purchasing power of the U.S. dollar. If that is more or less right, then the gold price goes up fourfold from here. People say to me, Rick, like, give your head a shake. Gold has already gone. It's already up 40%. If the analog is the decade of the 70s, let's assume that the move in gold price from $35 to $100 was a dead cat bounce off the restriction of the gold price. And let's say that the move in the gold price above 550 to 850 was morons piling on. That move from 100 to 600, six-fold move, is a pretty good move. And if the cause of it is the perception of the deterioration in the purchasing power of the U.S. dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the U.S. dollar. It was motivated by a negative real interest rate. We fought. Well, you didn't. Well, you were alive then. We fought the war in Vietnam, which we lost. And the highest marginal tax rate in the United States then, before weird deductions, was 80%, so we couldn't raise taxes. We had to deal with these social obligations. We did it not by changing the nominal value of our obligations, but really by changing the purchasing power of the dollar. The second thing that happened is that the way that the fear of inflation was expressed in the market, or put differently, the experience that consumers had with inflation juxtaposed to the rate that they got on their savings meant that interest rates were sharply negative. We had a 10% measured rate of inflation. We measured it, of course, differently then. And people were getting paid 5.5% on their savings accounts. That was reflected pretty clearly by a change in asset allocation from cash and cash equivalents or long-term bonds to gold. We have a circumstance today, Trey, where if your listeners believe in the CPI, they're pretty sanguine. You get a 4.5% yield in the U.S. 10-year Treasury. In a currency where your purchasing power is deteriorating by 2.5%, you're getting a 200 basis point real yield. I believe that's ridiculous. The CPI is not a good measure of the deterioration of the purchasing power of your savings. For one thing, the CPI doesn't include tax. Do you pay tax, Trey?
A little bit.
Yeah. If you look back at the basket of goods and services that the Reich family consumes, say, I don't want to test your memory and go too far back, but 2020 to today, gasoline prices, up 2.5% compounded? Hardly. Mortgage rates doubled. Groceries are a political issue, up 60%. And they're telling you that the deterioration of the purchasing power of the U.S. dollar is happening at the rate of 2.5% a year? I mean, what they're smoking is not legal to transport state to state to state.
For over 80 years, the U.S. dollar has maintained its position as the world's dominant reserve currency, a role established at the Bretton Woods Conference in 1944 and supported by America's post-war industrial strength and military reach. That status gave the U.S. unmatched influence over global finance, trade, and geopolitics. But that era is beginning to fray. The turning point wasn't just economic. It was political. The dollar started to lose its appeal when the U.S. began using it as a weapon, leveraging sanctions to pressure or punish other nations. That approach, while effective in the short term, prompted countries to find ways to circumvent the dollar altogether. As de-dollarization gains momentum, more nations are reclaiming their financial sovereignty and sidestepping Washington's grip. It's a shift that could restore real diplomacy, not one built on financial threats. RickRule has been closely watching these developments. He says he was surprised gold hadn't responded sooner or more sharply, considering the apparent warning signs. But to him, the key driver behind gold's rise has always been trust, or the loss of it. Specifically, when people stop believing in the long-term purchasing power of the US dollar, that's when gold moves. And Rule has been concerned about that erosion for a long time. It's not about the day-to-day headlines, it's about the bigger structural changes. As the world slowly breaks from the dollar's orbit, gold isn't just a haven, it's becoming the neutral ground in a fractured financial system. Let's get back to the interview.
I was surprised that gold hadn't moved further, faster, earlier. My belief, and Trey, you and I have discussed this over dinner, my belief is that gold does well when people are concerned about the maintenance of their purchasing power in US dollars. I've been concerned about that for a very long time. The arithmetic that concerns me is not expressed by the CPI, which I don't think is a good index. So I've been surprised by the muted response of gold hitherto. I didn't know, as you know, because we talked about it, when gold was going to move. But it seemed to me like an inevitability. As you and I both have talked about, I have a flaw in that I often confuse the words imminent with inevitable. But no, I haven't been surprised at all. I think it's way overstated. When I talk about the deterioration in purchasing power of the gold, I'm talking about in an absolute sense, not in a relative sense. I think relative to other currencies, gold will do well. Franz Pick said there's a lot of ruin left in a country this great. Ruefully, I agree with that. I believe that gold will be the world's reserve currency for the balance of my life. For the record, I'm a healthy 72-year-old. But I think its hegemony will reduce. When I look at
the dollar's hegemony.
Yes, it'll be reduced. I think the U.S. government is doing their best to destroy the U.S. Treasury as a savings instrument, politicizing it, debasing it. But what are the alternatives? My friend, our friend, Doug Casey, once said the dollar is an I owe you nothing, but the euro is a who owes you nothing. And I mean, the other analogy is the prettiest mare at the slaughterhouse. I'm not concerned about the dollar relative to other mediums of exchange. I'm worried about the dollar as a storehouse of my own wealth. I personally, Trey, save in gold. I personally maintain liquidity in dollars. Those are two different statements. I do consider gold to be a form of liquidity because I've proven to myself over 40 years that when the time comes, I'm not psychologically indisposed to selling it. One of the things I do, which I think your audience might find of interest, is that beginning in the year 2000, that was a momentous time, and I had a discussion with myself. Where did I want to go? What did I want to do? One of the things that I began to do was to keep an informal alternative ledger in gold. My net worth, my income, my expenses in gold. Rather than in the US dollar. And for that part of my ledger, when I look at what things cost today, I wish I'd been all in gold. Some stuff like rooms at this hotel, or a Big Mac, or a car, are really cheap. If you measure them in dollars, they're anything but cheap. But understanding that the dollar-gold exchange ratio was $250 to an ounce of gold at that point in time, if you equalize the numerator and the denominator, if you measure your savings in gold, you're struck by the deterioration of the purchasing power of the U.S. dollar, and you're surprised by the steady reduction in the actual price of many goods and services on a global basis if you're valuing them in a constant. It's a really interesting consciousness-raising exercise. Gold for me is insurance and savings. Gold stocks are investments. I don't own gold to make money. I own gold to maintain liquidity and maintain my purchasing power. I'm good at buying gold stocks. I've worked at it for 50 years. It's my craft. That's different. Owning gold stocks is one of the ways that I increase my store of gold. But they're different businesses. Gold doesn't require any work. Just like a life insurance policy doesn't require any work other than paying the premiums. So I regard them as very, very, very different asset classes. In a different part of my life, in addition to being an investor in gold mining companies, I'm a speculator in the juniors. And I have 50 years of mistakes, but there are three different buckets: insurance, investment, speculation. The cost of capital in the uranium business will become the lowest cost of capital in any resource business on the planet. At the same time, the certainty which lazy securities analysts you're talking to one, are able to forecast future revenues in the uranium business will be more clear than any other commodity. In other words, you won't have to shade your net present value calculation because you have no idea what they'll sell the product for. This is profound. This means that companies that normally, in a normal circumstance, wouldn't be able to build their deposit, they'd have to sell it, will be able to at least threaten the acquirer with the fact that they can build it themselves. They can obtain financing, because the financing is going to be obtained on Tokyo Electric Power's balance sheet or Duke Power's balance sheet. This is hugely important.
And how about the rare earths?
What I like about the rare earths is that nobody cares. I mean, nobody cares. They're not rare. Let's get that out of the way. They're not rare because, I mean, they're rare in the sense that we haven't looked for them because the Chinese produce them so efficiently. Two things. They're a geopolitical item now. People want to develop acquisition pipelines outside of China. So rare earths that could be utilized in Korean assembly or Japanese assembly or European assembly or American assembly, that is rare. The second thing is, and a lot of people know this, the Chinese have had an advantage in terms of cost because they've accepted extraordinary environmental destruction as a consequence of their rare earths industry. And that destruction is no longer acceptable in China. The Chinese people and the Chinese government are requiring much more responsible extraction, which means that the durable competitive advantage that the Chinese enjoyed for 25 years is going away. What I like about that is when I look at the discussion groups concerning rare earths, they never mention that. Soros said, find a widely held popular opinion that's wrong and bet against it. And this feels to me like just that. People that pay attention to rare earths don't pay attention to rare earths well enough to understand that Chinese production costs are rising rapidly and will continue to rise.
So that makes rare earths a good investment, or?
For me.
Oh, yeah.
For me. I mean, if you're somebody who requires positive psychological reinforcement, good stuff in the news, or if you have trauma holding stock over a long weekend, forget about it. And you're going to find this stuff and produce it likely in places like Malawi or Brazil that you may or may not be happy about. You know, I've kicked around bad jurisdictions my whole life and they bother me less. So if you have the psychological stability and the patience to be in a name for 5 years, be in a name for 5 years that may decline 30 or 40 or 50% before it goes up tenfold, rare earths are the spot for you. If you're not, you know, avoid this stuff like a plague. For me, Trey, my fondness dream is to buy what is potentially a tier 1 deposit, and I don't care about the commodity, a deposit with 20 billion or 25 billion dollars in situ recoverable reserves and resources, where that deposit would be in the lowest cost quartile in its industry worldwide, and where the deposit would be in the top quartile worldwide return on capital employed in a commodity that's out of favor. And I have that in rare earths. That's attractive to me.
Trust doesn't break all at once. It unravels slowly, then suddenly. What we're seeing now is the consequence of years of subtle erosion, not just in purchasing power, but in the credibility of the institutions managing it. Official narratives may point to stability, but markets are speaking in a different tone. When inflation data appears tidy on paper but doesn't reflect daily realities, people seek something more grounded. That's where metals come in, not just as hedges, but as measures of confidence in decline. Are we approaching the moment when hard assets stop being the alternative and start becoming the standard? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.